Welcome back, everyone, to another edition of The Explainer. If you love getting straight to the heart of the data, you are absolutely in the right place. Today, we're unpacking a pretty fascinating puzzle that just dropped from the June 2026 economic numbers. We're going to look at the data, decode what it means for the broader market, and figure out exactly how it impacts you, because right now, we've got some serious conflicting cross-currents happening between inflation and the housing sector, and honestly, it's creating a truly unique environment.
Okay, let's dive into this because this right here is the central mystery we're solving today. Usually, when we hear that inflation is cooling off, we expect a collective sigh of relief across the whole economy, right? Especially in real estate. But right now, the housing market just seems totally stuck in the mud. We've got falling inflation in one hand and a totally stalled housing market in the other. How on earth do these two things coexist? Well, let's take a quick look at our roadmap for today to find out.
So here's our roadmap. Number 1, inflation eases, pressure drops. Number 2, new homes, cautious rebound. 3, home sales hit the brakes. 4, consumer spending and job market. And finally, number 5, a summer family hack, ice cream.
All right, section 1, inflation eases, pressure drops.
Now, what's really interesting about this slide is that both the headline and the core consumer price index actually came in below expectations for June. Notice how month over month, the headline CPI literally fell. And this was completely mirrored by wholesale prices, which also dropped from May to June. So who's the primary hero of this story? Lower energy costs.
Getting into the specifics, consumer prices fell 0.4% for the month. And that was heavily driven by a nearly 10% drop in gasoline prices. So what's the bottom line for this huge consumer win? It massively reduces the pressure on the Federal Reserve to raise its benchmark Fed funds rate. Now, we all know the Fed doesn't directly set your mortgage rate, but their decisions act kind of like gravity on borrowing costs across the entire economy. They cut rates 3 times late last year, but they've kept them totally unchanged throughout 2026. Because of this cooler inflation data, policymakers are widely expected to just remain on pause. The Fed is always trying to balance its dual mandate, price stability and a healthy labor market, and this data, it finally gives them a little breathing room. Let's move to section 2 and see how this builds into the first half of the housing sector's mixed signals. New homes, cautious rebound. We're actually seeing a really striking rebound here. Back in May, housing starts completely tanked to a 6-year low. But look at June. Bam, a 19% jump in housing starts. That brings the annualized pace up to 1.43 million units. So that May decline, it looks like it was just a total outlier. June came in way above expectations, which basically means shovels are actually in the ground and construction has officially begun on these units. But here is where the mixed signal really flares up. Builders are breaking ground, absolutely, but their confidence, it's incredibly low. While we have that massive 19% jump to 1.43 million starts, the National Association of Home Builders Housing Market Index actually fell 2 points in July, down to 34. And as a quick refresher, anything below 50 means builders view the market conditions as poor. So what's with all the gloom? Well, builders are actively navigating some serious headwinds right now. Massive affordability challenges for their buyers, elevated mortgage rates, and really high construction costs. We all know, more supply is desperately needed to meet demand and support prices. But actually getting from permits to a completed home, that takes a whole lot of time and a ton of money.
All right, section 3, home sales hit the brakes. So let's flip the coin and look at the consumer demand side of the real estate equation. What are the buyers actually doing? Well, they're hitting the brakes hard. The pending home sales index, which tracks signed contracts on existing homes, totally confirms it. After a really solid 4-month streak of gains, pending sales dropped 5.4% from May to June. And this wasn't just some regional blip either. Sales fell across all 4 regions and were even slightly lower than this exact same time last year. And this brilliantly illustrates the core issue right now. Buyers are just incredibly sensitive to borrowing costs. Higher rates over these recent months have heavily weighed on demand. But there is a silver lining here. Because buyers are so reactive to these rates, if the cooler inflation data we discussed earlier eventually leads to a decline in mortgage rates, well, it could rapidly improve affordability. And that might encourage all those sidelined buyers to finally jump back into the market. Moving on to section 4, consumer spending and job market. Let's zoom down even further to the micro level. We've looked at inflation, we've looked at housing, but how is the everyday consumer actually faring amidst all these crazy mixed signals? So the crucial point is, the consumer is remarkably resilient. But the job market? It's starting to show some subtle, kind of hidden cracks. Look at retail sales. Overall, they increased by 0.2%, which was pretty much expected because cheaper gas at the pump naturally pulled down the total number. But when you exclude gasoline, retail sales jumped a very strong 0.7%. People are definitely still spending. But take a look at the labor market right below that. New unemployment claims look totally fine on the surface. They remain low at around 208,000. But that data might actually be masking the reality that some workers who lose their jobs are just turning to freelance or gig work instead of filing for traditional benefits. And the real tell? That's the bottom row. Continuing unemployment claims remain elevated at 1.81 million. That tells us that once someone loses a job right now, it is taking them significantly longer to find a new one.
And finally, Section 5, Summer Family Hack, Ice Cream. Okay, we have navigated some heavy, complex economic data today. You've earned a reward for sure. And since July is actually National Ice Cream Month, I want to pivot from inflation metrics to something way sweeter. Here is an incredibly easy family hack of the week, a no-churn vanilla ice cream. It makes 12 servings and literally requires no fancy equipment. First, you just whisk together a 14-ounce can of sweetened condensed milk, 2 teaspoons of vanilla extract, or paste if you have it, and a quick pinch of salt. Next, grab a separate bowl, use a hand mixer on medium-high to whip 2 cups of cold heavy cream for about 2 minutes. You're looking for firm peaks. Take about a cup of that whipped cream and fold it into your milk mixture. Once that's all combined, gently fold that entire mixture into the rest of the whipped cream until it's perfectly smooth. Finally, just pour it into a chilled loaf pan, cover it up, and freeze for about 2 hours until it reaches a sort of soft serve consistency. Stir in whatever you want, chocolate chips, peanut butter, crushed cookies, go crazy, and then freeze for 3 more hours until firm. It is simple, delicious, and honestly perfectly timed for the summer heat.
All right, before we wrap up today's explainer, let's bring it back to the data and look at what is coming down the pipeline. It is a relatively quiet week for economic news, honestly, but we do have 2 key reports to keep a close eye on. On Thursday, we get the weekly jobless claims report. That's going to give us a lot more insight into those continuing claims we were just talking about. And then on Friday, we'll see the June new home sales data, which will finally tell us that those 1.43 million housing starts are actually finding buyers.
It is a fascinating time in the economy, guys. Inflation is definitely cooling, but housing is just completely caught in this huge tug-of-war between high costs and sideline demand. And that leaves us with a final thought for you to ponder. With incredibly resilient retail spending, but an increasingly complex job and housing market, how are you navigating these mixed economic signals in your own housing or spending plans? Are you waiting for rates to drop, or are you just pushing forward anyway? Think about it as you enjoy that homemade ice cream. Thanks so much for joining me on this explainer, and I will see you next time.